Okay, this is where things get a bit tricky, but we can do it. So looking at FR24 December, we're looking at deferred tax. We know it's temporary differences that cause it. Now let's say we've had a revaluation of 100. Well, the tax base of that revaluation will naturally be zero, won't it? They won't tax you for just a revaluation, not until you've sold it. So we are showing more asset, which is the same as showing more income. So we need to show a deferred tax liability on this. Now let's say tax is 10%, 10% of 100. Deferred tax liability should be at 10. Hopefully we all agree. And then you're going to debit tax on the OCI of 10. Why are you going to debit tax in the OCI? Because that's where the revaluation gain would have gone. Now the revaluation gain not only goes to the OCI, it also goes to the revaluation surplus on the SFP, doesn't it? This is what I need you to understand. If you debit the OCI on your income statement, you are effectively debiting the revaluation surplus on your SFP as well. Literally what's happening is at the end of the year, they will credit the OCI and they will debit the revaluation surplus. Okay, but all you need to remember, if you debit the OCI, you debit the revaluation surplus. Just like if you debit the income statement, you debit retained earnings effectively. So there will be a debit going to the revaluation surplus as well here. Okay, so the revaluation surplus would look like this. Initially, you'd revalue it by 100. So you would debit the asset, credit the OCI, and therefore credit the revaluation surplus, which would increase it. And then you say, yeah, but we had deferred tax on that, so I have to debit it by 10, leaving a balance of 90. That's the tricky bit. Now let's have a look at a question from December 24. First of all, the easy question, what's the debit and credit to revalue land? Well, it's debit land, then you can either credit the revaluation surplus or credit OCI, doesn't matter which, because they're effectively both the same. So you credit revaluation surplus, the only choice we've got. And that's how you deal with it. A simple double entry there for a mark. I've just put the 10 in there just to show you, just a number. It's not actually 10. So you would credit revaluation gain on the OCI, and effectively that credits the revaluation surplus as well. Okay, literally, if you think, oh, there's too many credits there, there's not. At the end of the year, you would debit the OCI and credit the revaluation surplus. That's how it works. What would be the balance on the revaluation surplus? Okay. So they revalued their land to 300 and they'd bought it at 240. So hopefully you agree the revaluation is 60. Debit land 60, credit revaluation surplus 60. You would, of course, credited the OCI with 60, and that would have effectively credited the revaluation surplus with 60. But we've got 60 in so far, nice and straightforward. But because it's a revaluation, there will be some deferred tax on that. And it says 30%, and we've got to include this. So the 30% deferred tax on the 60,000 is 18,000. And what we do is we debit the OCI, which effectively debits the revaluation surplus. Why do we debit the OCI, not the income statement? Because the revaluation gain went to the OCI. Okay, the revaluation gain went to the revaluation surplus. So therefore the tax on that goes to the revaluation surplus. And you credit deferred tax liability. So your revaluation reserve, your revaluation surplus had a positive 60, then you took off 18. The answer is 42,000.